Let's say you had a real good job. You're making about $100,000 a year. Your credit score is pretty good. You check up on it monthly to make sure that you're keeping up with everything. Now you decide it's finally time to go after that dream home you've always been thinking about. So you go to your mortgage lender, you apply for a loan, only to find out that you've been rejected. What? Hold on now, hold on. I got a real good job. I don't think you heard me. I make $100,000 a year. So you telling me I don't qualify to get a loan at all? Like, I'm not trying to get a mansion. I'm just trying to get, a starter home. I'm trying to get a dream home. It doesn't have to be expensive, but yet the lender still denies me and won't loan me the money. How can that happen? That seems like a real unlikely scenario to a lot of people, but that can actually happen. And the reason for this is your debt to income ratio. Everybody knows about credit score and how you have to keep your credit score good in order to get a loan, but nobody talks about debt to income ratio, which is just as important, if not more important. Debt to income ratio is important because that's how lenders actually decide how much money they're willing to lend you without you being too much of a risk to them. The lower your debt to income ratio, the more money lenders are willing to give you. Income isn't the only way to qualify for more money or to get a good debt to income ratio. Don't forget about the debt side of it. So that means that there are more than one ways to improve your debt to income score or to hurt it severely. So if you're not really familiar on what debt to income ratio is, I'll show you in this video exactly what it is, how to calculate your debt to income ratio, how lenders use debt to income ratio, and if you stick with me to the end, I'll show you how to use the debt to income ratio to estimate the amount of monthly mortgage that lenders will be able to give you. Lenders find this ratio to be very important because we all know how uncertain life can be at times. We might be holding it together now financially, but in a moment's notice, anything could happen. For instance, we might lose our job, or you might run into some sort of unexpected expense like your car breaking down or anything like that. When something like that happens, it's more likely that you're going to have trouble paying off all your debt payments if you have more debt. That's why they like to use the debt to equity ratio. If lenders see that a lot of your monthly income is going towards paying debt, you're too much of a risk in their eyes, and eventually you won't be able to pay that lender. The lower your debt to income ratio, the safer you are in the eyes of lenders. On the other hand, the more debt you have, the riskier you are to lenders, and it's more likely that you will end up missing payments. Here are the debt to income requirements that most lenders use. For conventional loans, most lenders want to see you have a debt to income ratio of 36% or less. For FHA, VA, and USDA loans, lenders like to see you have a debt to income ratio of 43% or less. Now the million-dollar question. How do you calculate your debt to income ratio? What you'll do is take your monthly gross income, which is your yearly salary divided by 12. Then you divide that number by your total monthly debt payments. Once you do that, you have your debt to equity ratio. It's kind of simple, really. The real question is, what exactly counts toward your monthly debt payments? Well, what goes into your monthly debt payments are anything that you have to pay monthly for money that you've borrowed. So for instance, that can include a car note, that can include your student loans, and it can also include your credit card payments. Now, when it comes to credit card payments, you only include the minimum credit card payment that you have, not the payments that you actually make. Now, I know some of you may run off and start to calculate your debt to income ratio and see that, oh, I have a debt to income ratio of 15 or 20%, so I'm all good, right? However, remember that when lenders are calculating your debt to income ratio, you have to leave some room in there for the estimated mortgage that you're going to pay once you buy the home. If you don't have enough room in your debt to income ratio to fit in the mortgage that you want, you won't qualify for the loan, or you won't qualify for enough money to get the home that you want. So let's say, for example, that you do your debt to income ratio right now and you're at 40%, which is good enough for you to get an FHA loan. However, if you want to add a $1,500 mortgage to that debt to income ratio, you're going to be well over 43%, which means you won't be able to qualify for that loan. So just keep that in mind. When you do your debt to income ratio now, you have to leave room for the estimated mortgage payments that you're going to have. Keep in mind that the only things that do count towards your total debt payments are monthly payments that you have due to money that you've borrowed. So for instance, your rent or your utility bills or your cable bill or any subscription services like Netflix, Hulu, gym membership, things like that do not count towards your total debt payments. Still wondering how somebody who makes $100,000 a year can just be flat out denied for a loan? Simple, they have way too much debt. If you make $100,000 a year and divide that by 12, you'll get $8,333 that he makes per month. As far as their monthly debt payments, however, they have $1,500,000 a month that they pay in student loans. Yeah, law school can be costly. They also have $1,500 a month they pay in car payments. They have 2 cars, and hey, that new Tesla came out, and with these gas prices nowadays, who can blame them? And on top of that, they also have $500 in minimum credit payments per month because hey, if you have that new Tesla, you need the clothes to match the lifestyle. Add up all of those debt payments and you come out to $3,500 in total debt payments that they have per month. If you divide that by 8,333, you'll get the debt to income ratio, which is around 42%. With the debt to income ratio that high, it's pretty likely that most lenders that they go to are just going to deny them and want nothing to do with them. Now that you know why debt to income ratio is so important and how to calculate your debt to income ratio, how exactly do you improve your debt to income ratio? Well, of course, the obvious answer is to make more money, but besides that, what can you do? The first thing you can do is to get rid of any lower debt payments you have. Any monthly debt payments that you can get rid of as fast as possible, do that and you'll see a significant increase in your debt to income ratio. So for instance, if you have a car note that's almost paid off or will be paid off in a few months and you're looking to buy a home and you want to qualify for more money, pay that car note off now and just completely get rid of that monthly debt payment, and that will improve your debt to income ratio. Also, work on lowering your minimum credit card payments as much as possible. Remember, the thing you're trying to do here is to make your total monthly debt payments as low as you can. The lower it is, the better your debt to income ratio and the more money you'll be able to afford. There's also a pretty neat trick that you can use the debt to income ratio for. Using this ratio, you can actually estimate the amount of monthly mortgage that lenders would be willing to lend you. Now keep in mind that I said estimate, but this should get you in the ballpark of the amount of money that lenders will be willing to lend you. To estimate the total monthly mortgage you can afford, what you would do is multiply your gross monthly income by 43% if FHA or by 36% if conventional. Then you would subtract your total monthly debt payments from that number. Do that and you can get the amount of monthly mortgage that you can afford. Alright guys, that was my video on debt to income ratio. Hopefully I've explained everything good for you. If you have any questions or comments, please feel free to reach out to me either through the comment section below or through my website, which is BaileyAcresProperties.com. Once again, my name is Rob Bailey, Realtor in the Chicagoland area with ARNI Realty Inc. Thanks a lot guys. Have a good day.